maybe a quick show of hands. Who here have used a value investing approach to invest in the commodity sector before? Okay, great. So we got a few. Well, so that'll be good to maybe be able to compare notes. Let me first of all start off, before I talk about what I've done, I'll talk about what most people do in the commodity sector. And I'm going to concentrate almost all of my dialogue on the oil and gas industry, but this applies to mining, most obviously, and some other commodities. And that how most people invest in the commodity sector is what would typically be described as growth equity. And what they are mostly doing is trying to back a management team, a company, that's going to be able to find the commodity. That's really the core element. And some people are, some management teams are better at it than others, and a lot of it is sort of judging based on the technical expertise of management teams. It's good geology, geologists, engineers, geophysicists, and they'll say, oh, this team, man, they found this great play, and I think they're going to be able to do it again, and so I'm going to back them. And some of these are in corporate entities. That's really the dominant strategy, and it's a if this works, we're all going to get rich. That's kind of been the dominant thesis for a very long time, more than 100 years. It's gone on for a long, and that's how most capital gets put to work. Now, what that usually led to is a lot of capital goes into the formation of businesses with an idea to try and find a resource, get some production going, and then sell it to a big guy. That's usually sort of the investment strategy. And I've observed the industry for a long period of time, and I always thought it was a horrible industry. I was an advisor to it, and when I say horrible, it's just that it was just poor returns on capital. And why was it poor returns on capital? Is because all this money got spent trying to buy land, shoot seismic, drill wells, and it usually failed. Occasionally, you'd have a success, but it was quite seldom. Geez, that's kind of a lousy model on it. And then what happened, and this is particularly in the oil and gas industry the last 10 years, is that even if you found something and you got some production going, you'd actually end up finding it hard to sell. So even if you had that, that winning lottery ticket where you actually found something, man, you didn't get the big prize. But what I observed is, geez, that change in market dynamics, which was in the oil and gas industry, they got driven by a technology change. And that technology change was that for a very, very long time, finding oil and gas was really hard. The vast majority of all attempts failed. And then what happened is there was some change in technologies, and starting about 15 years ago, primarily shale, but also in the oil sands business. And over a fairly short period of time, the industry went from being drilling location poor to drilling location rich. And so what these historical buyers of existing production went from saying, geez, I used to buy these companies. Now I'm just going to drill it myself. And so if you actually had some production, your market demand fell on. It was really hard to sell these businesses. I thought, wow, you know what? This is going to create, and a lot of people also thought, there was kind of a cyclical, because this is a very cyclical business, which we can talk about. And what my observation was that most of the sector was interpreting what I would describe as a structural change for cyclical change. And that was going to create a lot of opportunity. So what we said is, geez, what if we use a value investing strategy? Forget this growth strategy. Forget trying to back smart technical people to go try and find stuff. why don't we just try and buy existing businesses with existing cash flow and see if that might be able to use it. What I would say, well, I say it's value investing. I'll go through this in some detail. Is that we'll just buy a whole bunch of businesses, but we'll do it in a way that is quite deliberate to try and build a single operating business. And in particular, we're going to actually try and really focus on high-quality assets, trophy assets. And I'll talk about why do you want to buy high quality on it. Now, buying a lot of these businesses, sometimes they're quite kind of complex. Sometimes they're like, complex situations. Often they're, sometimes these businesses are in bankruptcies. Sometimes they're subscale public companies. You got to take them private, integrate them. And importantly, as we were buying these businesses, the historic model of, hey, we're going to try and get this going, and then we'll sell it to somebody. He said, no, we're going to use a different approach. We're going to buy something and assume that we own it forever. When you're buying something and you assume you own it forever, you make a lot of different decisions on that. And the reason we did this is we ultimately fundamentally believed that this was going to be the best way to compound long-term intrinsic value per share, and at the same time have a margin of safety, protect our capital. And that compounding long-term intrinsic value per share with a margin of safety is how we have thought about value investing in the sector. Now, to develop a margin of safety, the first thing you've got to think about is, well, what kind of risks do you want to avoid? And in our view, there are 4 big risks in a commodity business. This is true in all commodities, and it's certainly true in the oil and gas business. And the first is technical, in that something is, you think that there's a certain amount of resource, a certain amount of production, and it ends up being smaller than you think. And that's, this first one scares a lot of people off. Because they think, geez, I'm not an engineer, I'm not a geophysicist, I'm not a geologist. But this is a very big and real risk. So that's the first big risk in the sector. Second big risk is the commodity price. That's the next big sort of scare factor that a lot of people have, because commodities go up and down. And they always go up and down, and it's not a question of, if it's going to go down. It's always going to go down. It's just a question of when it's going to go down. So then you have to think about, okay, well, how can you potentially protect yourself against that? But again, people don't like that. They say, I love the comment, oh, I want to have a business where the latte just goes from $7 to $8 over time, and you have to think about it. I get that. I always think about this more like the Buffett thing on Supercat, insurance. Volatility can be your friend. I like volatility. Volatility creates the opportunity. Because you know what there is? There's a lot of guides with a lot of spreadsheets saying, is that latte going from 7 to 750 or 775? There's a lot of calculations to kind of crank that down. I like the real big volatility. So this is, but lots of people get scared by this. Third big risk in the business is too much leverage. And the reason there's too much leverage in this is that commodity business typically is a real asset business. It's much more similar to, in some respects, the real estate business. The real estate business is also prone to over-leverage. Why is it prone to over-leverage? Any guess? Because the banks will give you the money. And what happens? If banks will give you the money, you know what happens? You take it. And that's why this thing gets over-levered. So you got to be really careful about it. And the last risk in this business is exit. So you get into it, and you try to manage all these games, and then you say, well, what if I actually want to be able to exit the business at some point? And if it's a simple private business, you may or may not be able to exit when you want to. So what we said about it is, well, these are the big risks, so why don't we just try and mitigate each one of these 4 risks, and then we'll develop a margin of safety. So how do you do that? Well, the first way is technical risk is what we don't do, and this is the super common thing in the commodity business, is we don't invest in the hot play. What's the number one hot play in the oil and gas? Everybody knows. You don't know if anything with the oil and gas business, you know this. Hey, that Permian, I hear the Permian in the United States, man, I hear that's really good. I hear that's really good. Yeah. If you hear about a play in Toronto, it's over, okay? Like, you're too late, okay? Like, that's been priced in. One of the, there's a old saw in the U.S. Oil and gas business, and that is, no good deal leaves Texas. If you're in New York and someone's got a hot oil and gas play for you, everybody in Texas has already seen it. Now, I would tell you, that is a very profound concept. It is extremely profound. So anyway, we don't invest in the hot place on it. What we want to do is we want to invest in plays that are extremely well understood, where there's all kinds of production, all kinds of established reserves on it. We're the opposite of, if this works, we all get rich. No interest. We get pitched those every day on. The other thing that we avoid is, the existing management, they're dummies. But, you just get bring some good management, you'll make it start working but no problem. It's very common, very common pitch on it. And it's also not the same thing. We'll ignore a poorly managed business. Sometimes there's opportunities. But the turnaround in the oil and gas business is generally quite hard. There's an old Buffett line, you guys all know, that when an executive with an outstanding reputation meets a business with a reputation for poor economics, it's usually the business's reputation which remains intact. That is extremely true in a resource business. It's really hard for a good executive to improve the rock. It's really an important concept. So we don't want to take that risk on it. So that's how we avoid the technical risk. Now, the commodity price risk, it's often misunderstood. And the reason it's often misunderstood is how most people in the commodity business deal with commodity price risk is through hedging. They say, geez, I don't know what prices are going to be, so I call up my local banker and I say, I just want to hedge in the commodity price. I'll enter into a financial contract, and then I won't be taking risk. And I said, and that's fine, and we do lots of hedging. But the real way to protect your price risk is to buy a trophy asset. And what's nifty about the commodity business is it's really easy to determine what is a trophy asset. You don't need you don't need a geophysical degree. It's really simple. And there's only two metrics. There's only two things you got to know. The first is, what is your sustainable break-even price? And that's the price at which you cover all your costs, including the capital to hold production flat. That second piece a lot of people forget about on it. And the lower that price is, the less price risk you take. The second metric you need to know in a commodity business is, what is your reserve life index? And that is, you take your existing production and how much resource you've got in the ground, and you divide those two numbers. And the longer that number is, the less commodity price risk you take. Now, why is that? Is that if you have, the longer the reserve life index you have, is that when commodity prices fall, and again, it's not if they're going to fall, they are going to fall, is that what that allows you to do is that while you continue to produce in a low price environment, you're not running out of reserves. Or if you have a really short reserve life index, prices go down, you have to keep producing and you're running out of reserves. The second thing about a long reserve life index is that part and parcel with that is you get a lower decline rate. So if you have a long reserve life index, you might have a decline rate of, say, 20%. Shorter reserve life index, say it's 40%. So what happens is when commodity prices fall and you have to cut capital, save money, if you only have a 20% decline rate, you're not working yourself into a big hole like you are with a short reserve life index. So the reason you buy a trophy, I mean the best asset you possibly can, highest margin, longest reserve life index, is not because, I just like quality, it's you take less price risk. So that's being a super important concept when you think about margin of safety in the business. So that's why how we deal with technical risk and how we deal with commodity risk. Now, the other way to think about creating margin of safety is how people underwrite a commodity business. In that what happens in a commodity business is people pay attention to a lot of things which can be highly misleading. And the first thing that people tend to focus on is future commodity prices and what's going to happen in the capital markets. We called out those are very important, but they're unknowable. Some guy comes and says, I got a real good view on where commodity prices are going. They don't know anything. Trust me, they know nothing. Okay. It's not that it's not important, it's just that it's unknowable. The second big problem that people tend to have is that you hear a lot in a commodity business about things that are knowable, but they're unimportant. These are most obviously, what is the enterprise value of the business relative to EBITDA? EBITDA, in this kind of a crowd, it's probably a friendly crowd in terms of criticizing EBITDA, which is good. Okay, a lot of people love EBITDA in the commodity business, and the commodity business is probably the worst business to be focused on EBITDA. And the reason being it's capital intensive to be able to hold production flat. But you also get a lot of other noise in it. People will say, I bought this business for X dollars per BOE in the ground. Well, I can tell you, $10 a BOE in the ground, as an example, could be a smoking deal or grossly overpaid. It means nothing. Someone will say, I bought this for $2 million an acre. Could be grossly overpaid or a smoking deal. Those are just metrics. Those are outputs, not inputs on it. So what we focus on, it's very simple, is enterprise value as a multiple of sustainable free cash flow. And as I mentioned, what is the cash flow after having spent all the costs, including the capital to hold production flat. Now, what's kind of important about this is that the other problem with the commodity business is you get a lot of engineering reports. Could be mines, could be oil and gas, and that is, this third-party engineer will go and look at the resource and say, geez, I've looked at all the boreholes, and you got this much resource, and this is how it's going to get developed over time, and here's a forecast for the next 50 years, and what people love to do with these engineering reports is build net present value calculation spreadsheets. You've never seen an industry who loves net present value spreadsheets than the oil and gas industry. Because and the reason being is you've got these engineering reports, and we do lots of spreadsheet work as well. But what we find, what's really works well, is a very old-fashioned method of underwriting approach, and that is, if I give you $1, how long is it going to take me to get that $1 back? And if it's not too long, say 4 years or 5 years, and I got a 40-year reserve life index, well, that sounds pretty good. I think I can make that work. As opposed to it's an NAV of 6% or something. It's a payback concept. It's a very old concept in the oil and gas business, but one that we think is extremely effective. We also look at other things. We like a lot of replacement costs. If you can buy below replacement cost, that usually gives you a little bit of a guidepost on it. You also can look at on the engineering reports. It's most obvious best is, hey, you used to say it was going to be like this. The engineering report. Now you got to revise it every year based on what actually happened. How have those gone? So look back economics are attractive. So that's how we think about dealing with technical risk and commodity risk. Leverage is probably the most easy thing in that we just try and maintain a conservative leverage ratio. To give a sense that we built our business, we generally kept it between 1 and 2 times debt to EBITDA. Just give you as a quick snapshot. Now, the last one, which is exit risk. This is one which has really led us to create have an investing strategy which is very different in that most folks want to develop a big portfolio, and someone will say, "Geez, I've got $1 billion under management, and if I'm going to be really concentrated, I'm going to have 10 investments, super concentrated." We thought, yeah, that's a good start. We said, you know what we're going to do? We're going to put all of our business into a single business. Now, why are we going to put all of our money into a single business? Because we want to lower the risk. We think that by putting all of our money in a single business, we lowered our risk. So how can that be? How could that be? Well, I'll tell you why I think that's the case. And this is the business that we built. We started in 2017, and essentially we made about 11 major acquisitions to build Strathcona, and we built a single business. And part of the trick, so to speak, is we would go into an existing area and make an initial acquisition, and then we'd buy 2 or 3 things immediately adjacent to it. The real estate analogy that I like is we try and find a good neighborhood, try and find a good street, buy a house, and then buy up the block. Now, why is that buying up the block so important? Is that allows you to take advantage of operating synergies and economies of scale. I mean, this is not a scattered portfolio. These are hyper. I have a fond criteria in terms of how we built our core areas, in that we'd say we'd only consider things that we could ride a bicycle around the asset base. And this is all in Washington. Washington has a very big place. Honestly, if you were able to do that, you developed these hyper concentrated areas, and that's what we did over this time. And by the way, this you'll see just in terms of the scale of the business that we built. Now, so why consolidate? Why put all your money in one business? Well, we want to take less risk on it, because first of all, these operating synergies, economies of scale, are very real, very powerful. This is a capital-intensive, operating cost-intensive business, and if you have geographic dispersion, it's very hard to be able to take advantage of that. The second thing is that as you do get bigger, you do lower your cost of capital, both your cost of debt and cost of equity. It goes down. Which also gives you then effectively better access to capital. But importantly, what that also then does, as you get to the big enough, is you don't have to, if you want liquidity, you don't have to wait for some third party to come along and want to buy your business. You can just take it public. And in my case, we've been a private equity fund. You can also then just start paying dividends and return your capital directly to your investors. And then ultimately, you can actually just return the capital to your investors by giving them the shares. So that's how we dealt with the four main risks. So that was the thesis. That was the idea. Now, what's it look like in practice? So this is the business we built. Started at 5,000 barrels a day. Today we're about 200,000 barrels a day. These are the core areas. Now, how do we measure success? So first and foremost, we look at calculating net asset value per share on a compound annual basis. That's our number one priority. And we've done that at a 21% compound annual basis. Peers have, in Canada, the Canadian average is 4%, same time. The second thing that we've looked at in terms of our definition of success is operating return on equity. And return on equity in the commodity business, if you folks have obviously invested in the commodity business, you'll never see return on equity. You never see it as a criteria. Why is that? For return on equity, you need something called net profits to actually. So we look at net profit on it. So that's been fortunate. Now, we've grown quickly, but again, quickly, it's always got to be on a per share basis. We've grown at a 16% compound annual growth rate per share, and about 19% compound annually on reserves on a per share basis. Now, let's talk about trophies. Why do you want to be a trophy? Now, there's a couple different ways. Here's the first way is, have we built a trophy business? And this is margin. This is all the peers in Canada, and the color coding at the bottom is just, are you an oil company, are you an oil sands company, or a gas company? But the yellow is your operating margin. And so the cheat sheet on this is you want to be on the left side of the chart, not on the right side of the chart. And so you want to have as high a margin as possible. And so, this is kind of like, if you think about this in any other sector, you want high margins. So, if you like Air Maze, that's good business. I love to own Air Maze. They're on the left side of this chart. They got a high operating margin. Now, on the left side of the chart, the far right side of the chart, those are super skinny margins. Probably not that effective a retailer. That's what. So you want to try and have be as far on the left side of the chart as possible. The other thing you want to think about is you want a really long reserve life index. And our business has the third largest, longest 2P reserve life index in North America. That's not in Canada. That's in North America. Probably a lot of things you hear about it. You may, again, have snippets. You hear a lot about the short reserve life index that's going on in the United States right now. So this is, again, those two things, high margin, long reserve life index, protects you from commodity price risk. Now, people say, well, geez, okay, yeah, so you've bought this stuff, but what about, what's the future look like? So I mentioned, we bought a lot of stuff, made a lot of investments, but of the 200,000 barrels a day we produce today, we've drilled the wells for about 60% of that production. So it's not we just bought it, we just sat there. This is an operating entity on it. Now, what do we want to do with it? Well, we actually think we're actually going to continue to grow it. And the reason being is we've got this hyper long reserve life index. It's great. We're saying, hey, it's 40 years from now. I said, but you know what? How about we try and bring some of that value forward? So we have a development plan that what we're going to do we're going to try to do over the next 6 years. This is all public use. This is a public company. This is off our website. This is not like some state secret on it. Is that we think we'll be able to maintain a 25% return on equity, and this is just at $70 WTI, which will end up like another $800 million in pre-tax operating earnings. So the increment, we've been averaging 25. I think the incremental return on equity is going to be like 60%. And by actually getting bigger, because there's fixed operating costs, we're actually going to lower our break even, which is already very low, even more, about $4 a barrel on it. And we'll continue to be, we're primarily an oil producer on it. At the end of this, we will still have a 20-year reserve life index. U.S. Large caps of this scale typically have about a 10-year reserve life index. We'll still be twice that long. Now, here's the real punchline for this crowd, because I know you guys are super smart thinking about investors. So this is the value proposition. So theoretically, and it's easy to build these charts. It's easy, build these projections, see how well you execute on it. But let's assume we just execute on this. Then what's going to happen is the business is going to be about 50% larger in 6 years. So it'll be around 300,000 barrels a day. Okay, we'll see if it works. Still have long reserve life index. At the same time, at $70 WTI, it's going to generate about $25 a share in free cash flow. Theoretically, we just dividend out to our shareholders. So the business today, 6 years from now, it's 50% bigger, so has long reserve life index, and along the way, theoretically, we could dividend something like $25 a share. Now, any guess, because I don't know if anyone knows, because I probably didn't even know, you don't think about it, geez, what's that worth today? Well, I can tell you, the share today trades about $25. So what you can do is you buy a share at $25. This isn't a pitch. This is a mention about why we like the business. Is you buy the share today, you hang around, you might buy $25 in shares in the next 6 weeks, and the business then is then twice as big as it is today. Now, that's why we like this business. That's why we like the sector. And by the way, because to go with that, what I was saying is, this has been a massively out of favor sector, massively out of favor. And because it's out of favor, we think that this is one of the reasons why we can do this. Now, how does this compare to the sector? Well, what's also important in the commodity business is you got to look at what people tend to focus on is what is your free cash flow yield? You've got your equity, and what kind of potential dividends can you get? Well, it's always a function of price. What's the commodity price going to be? What this chart just has some various different prices, ranging from $50 to $90. The middle part chart is $70. So the business today at $30, it's trading a little bit less than that right now. At $30 has a free cash flow yield of about 15%. But you get growth. You get yield, but you also get growth. So we think we're going to try and grow at 8% a year. So you got 15% free cash flow yield. You get 8% growth. You go 15 and 8. That's 23. You got to remember, this is a business that declines. People forget about that. So you got to take off the decline rate. We got a long reserve life index, so you got to take about 3% off. So what that means is at $70, you get a total return of about 20%. That's at $30. Now, we think our stock's underpriced. We just went public, didn't go public very long ago. So we think it trades at a higher yield, which we don't complain about just because it takes a while to get priced. Typically, an E&P company has a free cash flow yield of about 14%. Its decline rate, so its growth rate's lower. We have a higher growth rate with long reserve life index. It's only about 3%. So the total return pre-decline for the typical Canadian is about 17%. Because they have a higher decline rate, it's about 5%. So the total return for the typical E&P company in Canada is about 12%. Now, we like that compared to the U.S. Like why and by the way, I spent a lot of time in the United States. We put all of our money into Canada. Why are we going to Canada? We went into Canada because we think that the E&P business in the U.S. is actually overvalued. Why is that? Because, they get a free cash flow of about 12%. They have almost no growth, maybe 1%. They have a really high decline rate, 10%. We actually think the total return for the U.S. E&P sector is only about 3%. I get invited to no U.S. oil and gas conferences to speak. I'm not a big sought-after speaker. Now, how does that compare to the S&P or TSX? The free cash flow yield, as you guys would all know, is around 4%. Growth is about 4%. There's no decline, so you get about an 8% rate of return. So that's how we think about returns in the commodity sector. That was all I was going to talk about today. Thanks. Well, actually, my last thing I would just say, just one last thing I would say is I think it's, it's not, it's never, I think, appropriate to say, gee, I'm just like Warren Buffett, because there's only one. But I think you can say is, I've tried to copy things. And lots of people, don't copy well. But I have tried to copy a bunch of different things. One of the ways is how he runs his business. Not just how he invests it, but how does he run it. And how we, most importantly, do is how we've compensated people, all of our team at Strathcona, is we've tried to copy what he's done. And that is we incentivize our employees based on things that they can control. Things like F&D, what the cost is to find the reserve, their operating costs, what it costs to run the business, and the health, safety, and the environment of the business. And to do that, we provide no stock compensation, none. There's no long-term incentive plan, there's no option program. We pay cash salaries, cash bonuses, and the executives of the company have to buy stock out of their own pocket at the prevailing price, which again, just Buffett invented that 50 years ago. But we do find that has done a really good job of aligning management properly with the owners. So I think that's been quite an instrumental part of whatever success we've had. Anyway, that's all I've got for today.